Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, Matt Hornbach joins Global Head of Macro Strategy at Morgan Stanley. Hey, Matt, good luck with the Macro Strategy September 2025. When you sit at the table in a wonderfully collegially argumentative Morgan Stanley, how divisive is the debate?
Hi, Tom. Thanks for having me on. It's a pleasure to be back. Well, we don't have divisive debates. We have collegial debates, and I think in the end we all try to come to an understanding of all of the various perspectives that are informing investments taking place in the markets every day. It's obviously not just one perspective that ends up dominating the investment landscape. It's a collection of a multitude of perspectives. And so we like having those debates internally.
But the debates here center around an absolutely original Fed meeting. I remember years ago talking to Richard Berner at a dinner, former Morgan Stanley giant, about the dots. I mean, this is not a normal meeting of dots, is it, Matt Hornbach?
It certainly is not, and it's perhaps a meeting of dots and dissents, if I can play on words. In the end, the dots are a device that the Fed doesn't like to use as a guidance device, but unfortunately, investors have become accustomed to using the dot plot as just that, as forward guidance. And so this will be an important set of dots. As you know, we add an additional year to the dot plot in September. And we also focus very much on what the dot for 2025 implies for the final two meetings of the year. The consensus is that we will have a median dot somewhere between 2 or 3 cuts in total for 2025, including, of course, the cut that everyone expects at this meeting. But there's always surprises. And when the dots move, they tend to move a lot. So that will really be the main question I'll be trying to answer going into the meeting.
Matt, so as global head of macro strategy, where's the weighting for you guys these days, U.S. versus rest of the world? Because there was seemingly a little bit of a sea change there in the beginning of this year around the Liberation Day. Where are you guys right now?
Yeah, the dominance of the U.S. in macro markets is something that has been around for quite some time. Of course, I think one of the main reasons for that is because the central bank that most people in the world pay attention to more than any other is the Fed, of course. And so when you have all of these eyes around the world focusing on the same event, it can dominate investment perspectives and actions. So we are certainly focused on the U.S. at the moment. The U.S. economy is one where the labor market appears to be showing the most signs of strain. I don't want to use the word stress, but I think strain is an appropriate description of what we're seeing happen in the U.S. labor market. And of course, if the strain turns into stress, then we can expect the central bank to act much more expeditiously, to use a word that Powell has used in the past. So I think right now we are focused on the U.S., but we'll see. We'll see what happens in the economy into the end of the year, and maybe it will then be appropriate to focus on other parts of the investment world.
Matt, we got you on the YouTube video I see outside your office. I'm guessing some traders out there, and they're probably thinking about what they should be doing, how they should be positioned around 2 o'clock. How are you guys thinking about 2 o'clock and the 2:30 conference?
So our baseline view is that the Fed will lower rates by 25 basis points. We are expecting one dissent from a board governor, in this case, the newly appointed Stephen Myron. And so that's what we're expecting for kind of the main bits of the meeting. What, of course, people will be focused on quite a bit is, number one, the dot plot, as I mentioned earlier. Does that median dot settle in at 2, 3? How many, if any, dots are circling around 4 rate cuts in total for the year? That would be 100 basis points. I think very few people are expecting there to be a collection of dots showing 100 basis points of rate cuts, but there certainly could be, and that will be a point of focus. And then naturally, the press conference is an important part of the FOMC meeting now every 6 to 8 weeks.
Matt, with all your heritage of decades in Japan, at 2 o'clock today, in the press conference today, is Jerome Powell central banker to the world? Is he frankly central banker to Tokyo?
Well, he might be central banker to himself, Tom, in the sense that, we are now in the twilight period of his time as Fed chair. He has, just a handful of important meetings left in his tenure. I imagine the closer that he gets to May, the more he will start to reflect on his own time as chairman of the Fed. And perhaps he will start to think about the books that may or may not be written about him after he bids farewell to the Federal Reserve. In that case, he could be focused on doing what is certainly right for the economy, but also in doing what is right for the economy, he ultimately is going to be helping his own reputation moving forward.
Matt, thank you for your time. Matthew Hornbach is with Morgan Stanley. We thank him here on Fed Day. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Callie Cox joins Chief Market Strategist, Ritholtz Wealth Management. Callie, get us into earnings, but more importantly, get us beyond earnings into November and December. Is there going to be like a frenzy melt-up?
Well, I think before earnings, we need to talk the Fed and the government shutdown, because those are the two most prominent risk catalysts that are coming over the next few weeks. But one quick thing about earnings, Q3 earnings, obviously Q2 was a low bar. Companies hurdled that bar pretty easily, although I guess there are a few caveats, because I think you need to be looking at earnings on a sector by sector basis. The bar will be higher. I think analysts are still having trouble processing what tariffs could mean, especially with the new change that came at the beginning of August. But I'm really focusing on what the Fed will do as a precursor to what we'll see through the end of the year, and really the pushes and pulls in the government shutdown, especially as we head into October.
Yeah, but if we get past those, Paul.
Yep.
I'm sorry. I got solid GDP. I understand the tensions out there, particularly in the labor market. But Paul, where are we October 25th or something?
I know. It's time you talk about the resiliency, the courage to be in the markets. Callie, I know you folks over at Ritholtz Wealth Management are really long-term. You try not to get tripped up by the noise here. How has your kind of outlook kind of changed, if at all, during the course of 2025?
Well, it's funny. Our clients are long-term, but we don't pretend that the noise isn't there. Our clients are also hearing the noise. They have legitimate questions about the headlines that they see come across the tape. Where we sit, and, our outlook has been around leaning toward value for most of the year, especially because toward the beginning of the year, we had Liberation Day. We had these tariff pressures that we had to think about. And labor markets weren't looking the strongest heading into the year. And, we believe that the consumer drives the economy. If consumers aren't making money, then, Americans aren't spending like they usually are. So, we've been encouraging value. We've been encouraging, rebalancing your book, understanding what you own. We still think that this is prudent heading into the end of the year. And honestly, we think it's prudent for most of the time for our investors who are prioritizing stability and consistency. But it is a tricky moment, especially with economic projections pulling in one direction and then the labor market pulling in the other. It's tough to know where to prioritize.
What are people actually doing? Forget about the theory of Ritholtz, the theory of Callie, the theory of Josh. Are they still scared stiff?
I think there's some healthy skepticism out there. It's funny, the fears were high heading into April, fears were, to start the beginning of the year, I'll say confidence was high, and then it slowly tailored off in the first few months of the year. Now investors have those scars. They're heading into the fourth quarter. They know that the ground is shifting underneath them. We're getting a lot of questions on how to capitalize on this. I mean, mortgage refis, for example, are one of the big questions that we're getting, constantly, with the 30-year mortgage down near a 3-year low. And quite honestly, it's a hard question to answer because, the long end of the curve is one of the hardest things to talk about at the moment. There are a lot of catalysts whipping.
Callie Cox, stay with us here. We need to get the market open right now. The VIX 16.14. Here's Lisa Mateo.
You got it. And we'll start with the S&P 500. Right now, as we get the markets open, it's little change, little movement still. Up about a point at 6,608. I have to point out the levels. The Dow up 0.2%, 109 points at 45,877. We get to the NASDAQ right now. Not much movement there as well. Up about 2 points at 22,337. We go to the yield space. We have the 2-year at 3.51%. That's little change. The yield on the 10-year, 4.02%, and that is little changed as well. We have the Bloomberg Dollar Spot Index, not much movement there. We have Bitcoin down about 0.5% at just above 116,000. That is your Bloomberg opening bell report. Paul and Tom.
Thanks so much, Lisa. Greatly appreciate it. Callie Cox with us with Ritholtz Wealth Management. I'm sure it's been a point of discussion there and debate, and I'm certain with Barry, we've talked about it for years. Callie Cox on John Deere, which is the great CFA company to study in the brutal level 1 accounting treatment of the CFA Institute. Callie Cox, should John Deere report 4 times a year or like sensible Europe 2 times a year?
It's funny. So Trump brought this up a few days ago. I think this is the second time that he brought up the possibility of cutting earnings reports down to semi-annual, or at least less frequent than quarterly. I'm a big believer in transparency. I think markets are more efficient with greater transparency, but you have to look at this on both sides of the equation. It's lower compliance costs for companies. It's lower operating costs in general, although I don't think it would make much of a mark. Investors are on the losing end, though, and as we, for where we sit in the business, we're always on the side of the investor. The hardest person to ask is me because I love rifling through data, so I have a natural bias there.
She's on the conference call. Great quarter.
No. Hey, Callie, talk to us about
I wish.
The courage to be in the market right now. What's it take to get in the market today?
That's the heart of the matter.
I think it takes a strong stomach, but look, you have to do it. You can't predict where the bull market is, especially a bull market that's been driven by momentum and sentiment for most of this year. We keep reminding people that things feel uncomfortable. Obviously, there are a lot of catalysts to consider at this moment, but as rate cuts come, you will be paid less and less on cash. So cash management is key as we head into the end of the year. And look, nobody ultimately knows where this bull market heads. And, we could still be missing a lot of upside here, especially from those unloved sectors of the market that are more value oriented that we've seen shine over the past month or so with this rate cut rotation.
Callie, thank you so much. Callie Cox, Ritholtz Wealth Management. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is well-timed, to say the least. Randy Schrimmer's with us, who's been doing this a while, Vice Chair, Churchill Asset Management, and also Chief Investment Strategist. Oh, Chief Investment Strategist. Yes, should my grandmother have private credit in her 401k?
Look at the rest of our investors. We have 5 million teachers through the TIAA retirement program, including my brother and sister-in-law, who every Thanksgiving ask about how their portfolio is doing, right? So you're in good company. Look, what's interesting now, particularly my new role, is we're focused on one of the fastest growing channels out there, which is private wealth. What is private wealth, right? Private wealth is pretty much everyone. We all have private wealth. We all are looking for yield and we're looking for income. You know, I'm at a softball game with my daughter watching her play. Somebody comes up to me and says, "Hey, I think I heard you on Bloomberg last time with those guys. You seem pretty smart. How do I get into this asset class?" That is what a lot of people are thinking about, particularly when you look at the 60-40 model, which you guys are experts on. But what's happening is the alternative model, which is including 10, 20, 30% of non-correlated assets that have longer yield, less correlation, is getting a lot more action right now. And I haven't talked to you about this during most of our programming, but half of our committed capital is going to private equity and junior capital. Think about that. So we have probably our fastest growing products right now in private equity because the yields are better. And in the current environment, when GPs are trying to get more liquidity because the exits are slower, they're looking for more products that can help them get liquidity, not just for them, but for their LPs as well. So exits are a little slow, but for the best private equity firms, actually fundraising is pretty good. So you know I like to come every morning with you with a fun fact. Fun fact for us, our GPs that have been raising money this year in new funds have all hit their hard caps. What does that mean? You have a target cap of funds you want to raise, 500 million, billion, whatever it is. And then you have a hard cap above which you're not going to go because you don't want to dilute your existing investors. They've all hit their hard caps. That's different than the news you're hearing generally outside of Bloomberg about fundraising, because people saying, oh, fundraising is slow, not for the best.
All right. So I'm on your distribution list. I get notes from you guys. You're all over the world. What are you doing when you go to Asia, when you go to the Middle East, when you go to Europe? Are you looking for capital? Are you looking for deals? What are you doing these days? In my new role, but even, you know, you can think of me as like your new roles, you're focused on the private wealth side.
Private wealth, yeah.
Registered investment advisors.
And we obviously have institutional clients, but the key, and my friend Jess Larson, I'll give him a tip of the hat, over at Briarcliff, says that beta for private capital is performance. Alpha is education. Because you need to explain to investors what this private credit, private capital opportunity really is. You guys have been helping me. Are so grateful for that over the last several years, getting the message out, getting the gospel of private capital out. But what it means is that how do I get value out of an illiquid asset class? What is the benefit to me if I can't sell this thing?
What is the benefit to buying illiquidity?
Correct. And the answer is less correlation when markets trade down and more consistency and premium income when rates go down, for example. So we're going to see some interesting trends over the next few months and next year as rates start to come down.
I got to get this question, and we're going to have to run here on an incredible Fed day. But Randy, to me, what's at heart of the matter here is the big boys are going to come in. Churchill can manage its story. Fine, I get it. I love it. But the big boys are going to show up in private equity and particularly conservative private credit where you can make a coupon, blah, blah, blah. What's going to happen when BlackRock and the others send a wall of money into this environment?
So you know that the way we do deals is that we're an investor in the GPs. We're an LP, actually, in 400, roughly, GP funds. So we're getting the best assets from those investors that we've already pre-credentialed. We've already pre-qualified. Portfolio quality is destiny in asset management. If your portfolio is high quality, then you are going to be able to satisfy the needs of your investors. In order for it to be high quality, you have to be super selective.
How is our listeners and viewers going to do a credit analysis and quality analysis of the ginormous, huge bank on either Park Avenue or downtown West Street ETF fund in their retirement plan?
The beauty of retail investing is if you're investing in our funds, you're investing in the same funds that the ginormous sovereign wealth funds, including our parent company, $1 trillion TIA and Nuveen, are investing in. Same deals.
I'm in.
Oh, are you? Yeah, are you in leveraged? Are you in triple leveraged?
I should have taken my Chase Manhattan Bank credit training and gone into private credit.
You did
that. I do that again.
What was it like buying your first fancy white shirt and blue suit to do the?
Oh yeah,
folks, this is what Sweeney did. Was like gospel back then. It was like going to State Department.
Yeah,
you did private.
We all came out of MBA programs, and they said forget what you've learned. Now we're going to teach you. Now we're going to teach you how to do it.
He was very good, by the way. He was very good.
Well, Randy Schwimmer, thank you so much. With Paul Sweeney, looking at a whole new environment with private credit and private equity. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday.
Waiting with us is Andrew Lord Hollenhorst. He is with Citibank here on a Fed Day. The pomp and circumstance at the table at the Eccles Building today. Terminal. I was trying to go back to the 1980s and Wayne Angell and some of the fiery debates of monetarism. We've never seen this, have we, Andrew?
It's going to be a big debate today, I think, about not just what they should do at this meeting, although at this meeting we could have a couple dissents, but also where policy should be going, where the neutral rate is, what the balance of risks is. So everything is on the table at this meeting.
Paul Donovan at UBS, a student of the British process, said we're becoming like the Bank of England. Are we?
It feels a little bit that way, where you have just this big divergence between some Fed officials who didn't want to cut rates at all this year, other Fed officials who wanted to cut more aggressively and dissented back in July. We had Waller and Bowman with those 25 basis point cut view.
But should we notice, Paul, that Andrew Hollenhorst absolutely nailed the higher rate environment? Sure. I'm talking 2 years ago.
Yep, absolutely.
I mean, just absolutely nailed that.
Andrew, I mean, we had some strong retail sales yesterday. I mean, you could argue this Fed can be as cautious as it wants to be when you're thinking about 25 versus 50.
Well, if you look at the retail sales report, I think that's telling you this is an economy that's not going into recession. We have had a slowdown in growth. We've had a slowdown in consumer spending. Retail sales doesn't change that. And what retail sales really doesn't change is what's going on in the job market. And ultimately, that's the Fed's mandate. You look at those payrolls numbers, we had negative job growth in June. I know it was in a revision, so we don't really feel that way. But this is a Fed that would have cut already if we had those jobs numbers in real time.
So how do you think the cadence will go here for this Federal Reserve starting this afternoon?
So I think Powell, to Tom's point, has to bring together this committee, and I think he can bring them more or less together around a 25 basis point rate cut today. But you do have people like Waller who are dissenting, wanting to cut back in July. How do you keep Waller on board with just 25 basis points today? I think you have to be a little bit dovish in the press conference. So I think we're going to hear Powell be a little bit dovish to kind of indicate that this is a Fed that could be cutting at each meeting this year. I think we see that in the dot plot, and then continuing to cut next year.
Okay, but that's where I wanted to go, to cut this year. Some people are saying 3 this year. I don't want to do the parlor game, Andrew. You know, I hate it. But here's the reality. I've got nominal GDP Q3 off Atlanta Fed of at least 4.5%, 5%, dare I say 6%. I don't think I can say that, but with the consumption and retail sales, there we are. Does that strengthen the one and done feel of today's meeting, or is he really going to anticipate out a set of rate cuts?
I think it's a set of rate cuts, and I think that's where Chair Powell was starting to go at Jackson Hole. Remember back in late August, when we had Powell saying this balance of risks is starting to move more in balance between downside risk to employment, upside risk to inflation. Now we have even more downside risk on the job side. You're right, Tom, we've run very strong nominal growth through 2024. The first half of this year was slower nominal growth.
What's your nominal growth 12 months forward?
12 months forward from here will probably be 4 to 5% nominal growth. So not that 6-7%.
That's terrible. Cut rates on me. I'm sorry, I'm lost on this. Paul, save me.
Exactly. So talk to us about this labor market. Let's dig a little bit deeper in there. For the first time I saw recently, number of job openings versus the number of people kind of looking for jobs, kind of a little bit more in balance now. And it used to be, boy, there's so many more job openings out there. Yeah. And that gave you a sense, there's this economy, the labor economy is a lot stronger than maybe we think. Is that not the case anymore?
It doesn't seem to be the case. We obviously have big differences between which labor market series, which job series you look at. But the payroll numbers look very concerning now after those revisions. That probably looks the most concerning of any series. But if you look at some of the survey data, if you look at in the consumer surveys, when you ask people, are jobs hard to get, that number is going up. People are finding this to be a more difficult market to get a job. We're also seeing if you switch your jobs, how much is your pay going up when you switch your jobs? That's really not normalized. You used to get a big premium for switching your job. That would indicate it's a labor market more in balance.
No, that was my game plan for 20 years. It worked just fine. So, Andrew, if I'm the Fed here, I mean, I'm looking at the labor market. Maybe why wouldn't I be a little bit more aggressive here? Would that signal, there's something else under the hood the Fed sees and maybe the market doesn't see?
I think there's nothing pushing them to be super aggressive at this meeting. When you really have a big push to be aggressive, well, it's like what happened a year ago where you had data that was coming in softer than expected, and you had the equity market selling off. You had risk assets that were performing poorly. And that's part of what pushed the Fed to deliver that 50 basis point rate cut back in September of last year. This year, as the Fed is getting priced to cut, we're seeing equities rally. We're seeing very high prices for risk assets and looser financial conditions. So the Fed isn't working against tightening financial conditions here. We actually have loosening financial conditions. Yep. Fed cuts are going to feed into that. I think there's no pressure for 50 basis points today.
The press conference today, what would be the question you would ask?
I think the key question that I would want to know from Chair Powell is really what you were asking, Tom, which is, should we be thinking about this as a adjustment? Right. Are we just calibrating rates slightly lower? Or is this a real rate cut cycle? Is it a rate cut cycle that started a year ago, right, paused because we had tariff uncertainty, inflation uncertainty, and now we're picking it up again?
Lord Hollanders, thank you so much. I'm giving everyone a title today.
Thanks for that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.